The host begins by recounting his personal experience of buying gold and silver at what appeared to be an all-time high in the market. The story opens not with triumph, but with reflection, emphasizing that even in a bull market, the moment of purchase can feel uncertain. He shares the exact pieces he acquired, a gold coin and a silver coin, noting the timing and price levels to provide concrete context for viewers. This introduction establishes the narrative lens, the perspective of an individual navigating elevated market conditions. The focus is on observation and experience rather than speculation or hype. By framing the purchases in this way, the host immediately signals that the discussion will explore lessons drawn from action rather than from theory. The story sets up the tension inherent in buying at market highs. Prices were rising, excitement was building, and the natural question arises, had he entered at the peak? This uncertainty becomes the lens through which the broader discussion unfolds. The audience is invited to consider the psychological impact of timing, expectations, and market perception, all without introducing extraneous market data. By opening with this personal narrative, the host creates a relatable entry point. The purchases are tangible, specific, and framed in a way that illustrates the challenges of acting in a volatile market. The anecdote establishes credibility and sets the stage for deeper reflection on the nature of precious metals, their role in wealth preservation, and the mindset required to hold them effectively over time. The host then frames gold and silver in contrast to fiat money, emphasizing their role as tangible, sound money rather than abstract financial instruments. Unlike the US dollar or other fiat currencies, which he describes as debt-based and subject to inflationary pressures, precious metals exist independently of government balance sheets. They have been recognized as stores of value for thousands of years, and their intrinsic properties, scarcity, durability, and divisibility, anchor their worth across time and cultures. This distinction is not merely academic. It underpins the rationale for holding metals through periods of market volatility. Whereas fiat currency can be devalued or printed in excess, gold and silver are limited by nature and production. The host underscores that this tangibility is what provides enduring security. When other assets fluctuate, metals retain a baseline of purchasing power. By highlighting longevity and historical precedent, the discussion reframes perception of risk. Investors accustomed to financial instruments may evaluate volatility in terms of short-term losses or gains. In contrast, the host encourages viewing precious metals through the lens of preservation, where temporary fluctuations are less consequential than long-term stability. This philosophical foundation prepares the audience to understand the subsequent points about wealth preservation, disciplined holding, and managing expectations when entering the market at high prices. Gold and silver are not being presented as speculative instruments. They are assets whose value is anchored in physical reality, independent of transient market sentiment. The host next emphasizes that gold and silver are primarily tools for wealth preservation rather than traditional investment vehicles. While prices may spike or dip dramatically over short periods, the central purpose of holding precious metals is to maintain purchasing power and safeguard assets against systemic uncertainty. They are not intended to generate quick profits or win in the conventional sense of investing, where success is measured by short-term returns. This perspective shapes how one interprets market highs. Buying at what appears to be a peak does not inherently constitute a mistake, because the goal is not timing the market, but preserving value across decades. Price volatility is reframed as an expected, manageable phenomenon rather than a threat. The host stresses that those who treat metals as speculative tools risk misunderstanding their fundamental utility. The discussion also addresses psychological preparation. The host notes that holding tangible assets requires patience and mental discipline. Temporary declines, sharp corrections, or perceived overvaluation are part of the natural rhythm of markets. The holder's focus should remain on long-term resilience rather than short-term profit. By drawing this distinction, the narrative separates metals from conventional financial assets. They are not benchmarks for performance, but anchors in a portfolio. This framing reinforces the idea that even buying at elevated levels aligns with a philosophy of preservation, as long as one maintains perspective and accepts volatility as an inherent feature of the asset class. The host then turns to the reality of market volatility and the mental preparedness required to navigate it effectively. Purchasing gold or silver at perceived highs naturally invites stress, as short-term price movements may create the impression of immediate losses. The key, he emphasizes, is understanding that such fluctuations are inherent and should not dictate decisions to buy or sell. He frames volatility as a test of discipline rather than a signal of error. Prices may spike or decline sharply, but the long-term value of tangible metals persists independent of day-to-day market swings. The host advises that holders maintain a steady perspective, recognizing that temporary market corrections do not undermine the fundamental purpose of their assets. This section also introduces the concept of endurance in holding. The act of accumulating metals is not a one-time event, but a continuous process requiring commitment. By mentally preparing for periods of uncertainty, holders can resist reactionary behaviors, such as panic selling during downturns or overenthusiastic selling during rallies. The host reinforces that the objective is not profit maximization on short-term trades, but sustained preservation of wealth. Understanding volatility in this context shifts the focus from price anxiety to strategic patience, aligning the mindset with the enduring nature of precious metals themselves. The host then introduces dollar-cost averaging as a practical strategy to manage the risks of buying at market highs. By purchasing metals in smaller, consistent increments over time, a holder can smooth out the average acquisition cost and reduce exposure to short-term price swings. This approach transforms the challenge of entering a high-priced market into a disciplined, structured process, rather than a gamble on perfect timing. Dollar-cost averaging reinforces the long-term perspective emphasized throughout the video. Instead of attempting to predict peaks and troughs, holders focus on steady accumulation, ensuring that occasional market highs are balanced by purchases made at lower points. Over time, this methodology reduces the impact of volatility on overall holdings, providing a buffer against sudden corrections. The host positions this strategy as an extension of the wealth preservation philosophy. It is not designed to generate quick profits or exploit short-term fluctuations, but to maintain the integrity of the stack over years or decades. By emphasizing process over timing, dollar-cost averaging provides a practical mechanism for aligning action with principle. This discussion bridges philosophy and practice. It demonstrates that even when markets appear overheated, a disciplined, methodical approach allows holders to continue building their positions without succumbing to emotional reactions. In this way, timing risk is mitigated, and long-term preservation remains the guiding principle. The host then addresses liquidity considerations in the precious metals market, highlighting that owning gold and silver is not synonymous with immediate access to cash. Retail products, in particular, can face challenges when trying to sell, especially during periods of high market activity. He notes that peer-to-peer transactions, such as those conducted through reputable platforms or private networks, may offer the most reliable avenue for buying and selling in these circumstances. The discussion emphasizes the importance of diligence and research when selecting dealers or trading partners. Not all sources offer competitive prices or consistent service, and differences in reputation and reliability can significantly impact the ease of converting metals into cash. The host encourages comparing options and seeking out trustworthy intermediaries to avoid unnecessary losses. This section reinforces the practical dimension of holding precious metals. While accumulation is guided by long-term preservation goals, liquidity remains a functional consideration. Being prepared for potential delays, lowball offers, or restricted access ensures that holders maintain flexibility and can act strategically when needed. By integrating liquidity into the broader narrative, the host bridges philosophy with operational reality. Preserving wealth is not only about ownership, but also about ensuring that metals can fulfill their intended role in maintaining purchasing power when circumstances require. The host then highlights Summit Metals as a practical example of a reliable dealer that supports holders in navigating high market conditions. He emphasizes that Summit Metals consistently offers competitive pricing and maintains strong customer service, even when market activity surges. This endorsement is presented not as promotion, but as a demonstration of the type of diligence and reliability holders should seek when acquiring precious metals. By referencing a specific, trustworthy source, the host illustrates how careful selection of dealers can mitigate some of the operational challenges discussed earlier, including liquidity constraints and inconsistent pricing. Reliable partners provide a foundation for executing purchases or sales confidently, ensuring that the stack remains both secure and accessible. The discussion also reinforces broader lessons. The value of precious metals is not solely in acquisition, but in the systems that support their use. Having access to dependable dealers and platforms adds a layer of operational stability, complementing the long-term preservation and philosophical principles outlined throughout the video. This section serves as a bridge between strategy and practice. It underscores that ownership is not abstract. It requires actionable support structures to fulfill the purpose of wealth preservation effectively. The host concludes by synthesizing the key lessons from buying at what seem to be market highs, emphasizing that timing is secondary to perspective, discipline, and purpose. While short-term price movements may provoke anxiety, the overarching principle remains: gold and silver exist to preserve wealth, not to generate speculative gains. He reinforces that temporary market highs do not invalidate purchases. Even when acquisition occurs at elevated prices, disciplined holding, dollar-cost averaging, and careful attention to liquidity ensure that the metals fulfill their role over the long term. Price fluctuations become context rather than catastrophe. The closing perspective ties together the philosophical, practical, and operational elements discussed throughout the video. Ownership is framed as a long-term strategy requiring patience, mental resilience, and thoughtful management of both market and logistical realities, precious metals are anchors in financial uncertainty, and their value is realized not through immediate trading, but through measured, deliberate stewardship. The host leaves the audience with a clear takeaway. Success in holding gold and silver is defined by preparation, understanding, and endurance, not by hitting perfect market timing. In this sense, perceived highs are opportunities for reflection and disciplined action rather than mistakes to regret.